Hi there. My name is Jeremy Anderson. I'm one of the notaries public at Old House Notary here in Courtenay. Our client-centered practice assists clients with estate planning by drawing wills, powers of attorney, and representation agreements, and with buying, selling, and financing real estate. But today I'm going to talk to you a little bit about property flipping, both the federal rules and the new BC provincial rules. Now, the federal government was first to try to address property flipping through legislation, but housing falls under the jurisdiction of provinces, which means that their ability to legislate property flipping is pretty limited. So they turn to really the only tool they have, which is the Income Tax Act. Now, as it relates to real property, where there's a gain on disposition, in some situations that gain is considered to be business income, and in other situations it's considered to be a capital gain. And of course, by gain, what we mean is the difference between the proceeds from the sale and the original cost of that property. Now, most people know that when you sell your principal residence, it's generally exempt from tax. But what most people don't realize is that the principal residence exemption is not a given. It's subject to the intention of the taxpayer. And what I mean by that is that the gain on any property bought with the main intention of selling that property is subject to tax, notwithstanding any other factors. Now, what has changed is that as of January 1st, 2023, any gain from disposing of residential property that's owned or held for less than 365 days before the disposition is now deemed to be business income and not a capital gain. So in other words, if you hold real property for less than a year before selling it, the principal residence exemption is not available to you. And where you need to be particularly careful is with respect to an assignment of sale, because that 12-month holding period resets once the transaction actually completes. And not only will the CRA get you on the way up with that, but they're also going to get you on the way down. So if your endeavor to turn a quick profit turns into a loss, that loss is going to be entirely denied. And what happens if you don't report a sale of real property correctly as being either on account of capital or on account of income? Well, not surprising, the real estate sector is one of the many that CRA regularly audits. And CRA isn't at all secretive about that activity, or the fact that it has recently increased its compliance efforts in the real estate sector, particularly in areas where speculative activity has increased. And when the CRA is looking at whether a transaction has been characterized correctly, they're going to look at a number of factors. For instance, the type of property, the length of time you owned that particular property, your history of selling similar properties, any work you did on the property, and of course why it was sold. Basically, it all comes down to substance over form, or your intention. So for example, if the facts support that you purchased your property with the intention of it being your principal residence, then of course you ought to be entitled to the principal residence exemption. And if you bought a property with the intention of it being income producing to you, so in other words a rental property, then it would generally be on account of capital. However, what offends current public policy is speculators, those who purchase real estate with the intention of generating a short-term profit, either by assigning a contract or by buying property with the intention of renovating it and flipping it. And even if you live in a property while you're renovating it to flip it, that doesn't entitle you to the principal residence exemption, because of course your intention was always to buy, improve, and sell for profit. And what the Income Tax Act now says is that unless you qualify for one of the specific exemptions, if you own a property for less than 365 days, you are deemed to have acquired your interest in that property with the intention of flipping it for a short-term profit. And in that case, you have to report it as a sale of business income and not as a capital gain. And ultimately what that means is that you're going to be taxed on that profit at your individual marginal tax rate, and you won't receive the more favorable treatment for capital gains. Now, the intention of these flipping rules is to target speculators. And of course, we can all imagine situations where an owner might have to sell a property in less than 365 days for reasons other than speculation. So there are some exemptions. For instance, the year of death of a taxpayer or a related person joining a household. So for instance, a family gets bigger and they need a bigger house to accommodate that bigger family. If there's a breakdown of your relationship and you've been living apart for at least 90 days. If there's a threat to your personal safety or the personal safety of a person related to you, if there's been a disability or illness of the taxpayer or a related person, if there's been a eligible relocation, And by that we mean, generally speaking, moving to a new home that's at least 40 kilometers closer to a new work location. Also for reasons of financial hardship, such as the involuntary termination of employment or the insolvency of a taxpayer. Or finally, if the property was destroyed or expropriated against the taxpayer's will. Now this year, on January 1st, British Columbia itself introduced a new provincial flipping tax. The tax applies to profits that are earned from selling residential property in British Columbia, including pre-sale contracts, if that property is owned for less than 730 days. Now, if the transaction involves a pre-sale contract, it's important to be aware that you are deemed to have acquired that property as of the date of the original contract. And it's interesting to note that this is in contrast to the federal rules that we just talked about a moment ago, where that holding period resets. So the government gives us an excellent example on their website that says, if you purchase a pre-sale contract on, say, June 1st of 2025 for a condo that's going to complete in March 2027, if you buy that condo when it completes on March 1st, 2027, you'll be considered to have acquired the property back on June 1st, 2025. And in that case, you won't be captured under these new rules. And the tax applies to individuals, corporations, partnerships, and trusts, all alike, that sell or dispose of a taxable property on or after January 1st, 2025. Now, it's important to note that a disposition doesn't just refer to transactions where money changes hands. It applies to any form of consideration, whether cash or in kind. But it doesn't apply to any gifts, a legal transfer of title where there's no corresponding transfer of the beneficial interest, or where there's been a deemed disposition for tax purposes. Now, the tax applies to the net taxable income from the disposition of taxable property that's owned for less than 730 days. Initially, the tax rate is 20%, and like the federal flipping rules, that applies for the first year. After that first year, the rate is going to decline on a straight line basis until you reach day 729, at which point the rate is now zero. So how is the tax calculated? Well, first you need to calculate the taxable income from the sale, which is calculated as the net proceeds from the sale. And by net, we mean net of real estate fees, appraisal fees, real estate commissions, inspections, surveys. So the cost that you incur in order to sell the property. From that, you're going to subtract the cost that you incurred to purchase the property, which will also include legal fees, any taxes you paid, such as GST or the provincial transfer tax, survey, registration fees, and title insurance as well. You're also going to subtract from that the cost to improve the property. And what we mean by that is any costs of an enduring nature. So regular repairs and maintenance, unfortunately, don't count. You can, however, also deduct the cost to purchase major appliances, but not any financing costs associated with that. And if the property has been your primary residence for the last 365 days, you can deduct from that taxable income any share you have of the $20,000 primary residence deduction. And your share would be based on your proportionate interest in the property. So in other words, if the property is held for more than 365 days, that $20,000 primary residence deduction would be available to you. If not, it is not available to you. From there, you need to figure out your tax rate, which, as I said, is 20% for the first 365 days and then decreases on a straight line basis after that. Lastly, you need to calculate the taxes that are going to be payable by multiplying the net taxable income by the tax rate. So to give you a sense of the quantum of this tax, let's walk through an example. Let's say you purchase a property for $900,000 on the 1st of May back in 2023. And you sell that property on January 31st, 2025 for $1 million. And let's say you also put $10,000 into the property for improvements. So in that case, your taxable income is going to be $90,000. Now, if you also lived in the property during that period of time, you would also be eligible for the full $20,000 primary residence deduction. And that means that your net taxable income is going to be $70,000. Now, you would have owned the property at that point in time for 642 days, so your rate of tax would be 18.082%, which means that the taxes payable would be your $70,000 net taxable income times that rate of 18.082%, which gives us $12,657 in taxes payable. Now, there are a few limited exemptions from this tax, primarily if the property was used exclusively for commercial purposes for the entire period that you owned the property. But commercial purposes doesn't necessarily exclude you from operating a home-based business in a portion of the property. Now, it's important to be aware that if the tax applies to any transaction, a return has to be filed, regardless of whether your calculation of the taxes payable results in a no taxes owing, or if you have an exemption that results in no taxes owing. And that return has to be filed within 90 days of the date of the transaction completed. Now, if you fail to file a return, you're going to be assessed a penalty that's the greater of $500 or 5% of the balance owing plus an amount that's determined by a specific formula. You will also be assessed a 3% interest rate on any outstanding taxes owing.